remains a major preoccupation for central bankers, economists, politicians, investors and workers. So the latest round of monthly figures from both sides of the Atlantic will be very closely watched indeed. The Office for National Statistics will release the UK inflation data for January on Tuesday the 14th of February. Remember that in December, their headline Consumer Price Index, or CPI, rose 10.5% year on year. That rate of increase was slower than in November and represented the second consecutive month in which the rate of change had decelerated. Financial markets are now hoping that October, at 11.1%, represented the peak, and that further slowdowns in the rate of inflation will give the Bank of England a chance to pause when interest rates hit around 4.5% mid-year, compared to the current 4% base rate, and then give the bank a chance to start cutting in late 2023 or early 2024. Governor Andrew Bailey and the Monetary Policy Committee must still navigate between not tightening too much, whereby the economy could tip into recession, and loosening too quickly, which could commit a second round of inflation and force an even tougher round of new rate rises. That's what happened in the late 1970s and early 1980s. And remember, the Bank of England's sole mandate is actually to keep inflation at or around the 2% level. The US Bureau for Labour Statistics will then follow up with the latest inflation data for America on Wednesday the 15th. America's rate of inflation, as measured by its own version of CPI, peaked at 9% last June and, according to December's reading, has since receded to 6.4% year on year. That's still way ahead of the Fed's target, which is also 2%, although Chair Jay Powell and the Federal Open Markets Committee are also mandated to manage employment levels. So, strong labour markets and wage growth will remain a key consideration for those policymakers. Nevertheless, financial markets think that the US Federal Reserve funds rate will get to around 5% from the current 4.5% and then pause before Mr. Powell and colleagues start to cut rates in response to slower inflation and possibly recession later this year or early next. Again, it's those hopes for a return to cheaper money that are fueling much of the current rally in stocks, bonds, cryptos, you name it. So if inflation proves stickier than expected, there's a chance that markets could become more volatile. Back on the home front, there's a busy slate of scheduled corporate news from large, mid and small caps alike. Names which may be worthy of further study include the following, although some of these dates could yet be subject to change. Coca-Cola, HBC and TUI on Tuesday the 14th of February. Glencore, Dunelm and Pan-African Resources on the 15th. Standard Chartered, Centrica, Relics, Travis Perkins and Indivior on the 16th. And Segro, MoneySupermarket.com and NatWest on Friday the 17th. But it's another bank, Barclays, which could just cause the biggest fuss when it reports fourth quarter and full year results on Wednesday the 15th of February. Even after a mighty rally from October's lows, the shares are trading below where they were a year ago, amid worries over the UK mortgage market, the British economy more widely, the health of its chief executive, C.S. Venkatakrishnan, and also how the investment bank is doing amid a dearth of real new flotation or merger and acquisition activity. The headline number to watch is pre-tax profit, and analysts are penciling in £1.5 billion for the fourth quarter. That compares to £1.4 billion a year ago. For the whole of 2022, pre-tax profit is therefore expected to be £7.2 billion compared to £8.4 billion in 2021. One big swing factor here is the second quarter's £1.3 billion regulatory fine in America for product mis-selling, but analysts will then look to three other key swing factors in the profit and loss account for both the fourth quarter and the year as a whole. The first is net interest margin. Higher interest rates and at least wider credit spreads would help Barclays here, and in the third quarter the net interest margin at Barclays UK was 3.01%, more than half a percentage point higher than mid-2020s low of 2.48%. Maybe the margin tide has turned. And while a half percentage point or 50 basis points might not sound a lot, Barclays does have a £414 billion loan book. So each basis point of net interest margin, or 1/100th of a percentage point, could, in theory, equate to an extra £40 million of profit. The second factor to watch is loan provisions. Loan losses have started to creep up again, especially relative to 2021, when Barclays wrote back some of the loss provisions it took during the COVID-stricken 2020. Analysts are looking for another increase to £504 million in the fourth quarter, to take the cost for the whole of 2022 to £1.2 billion. But the IFRS 9 accounting standard makes this difficult, as banks must now provide a current expected credit loss, or CECL, so they can't wait until a loan goes sour. They must make an estimate for a loss if they think it might go sour. That's going to be pretty interesting at a time when UK consumers' pockets are being squeezed by inflation, and indeed as they are in America. Remember, Barclays has got a £161 billion mortgage loan book, a £9 billion credit card book in the UK, and a £24 billion credit card book in America. Finally, analysts and investors will look to the investment bank. Activist investor Edward Bramson of Sherborne Investors got nowhere with his calls to spin off the capital-hungry investment bank and break up the group, but it may not be too wise for shareholders to do a victory lap just yet, as pre-tax profit from the operation fell year on year in each of the first, second and third quarters of 2022, and the consensus for the fourth quarter is £682 million, a third lower than the year before. Overall, the investment bank is expected to make £4.4 billion pre-tax in 2022, not to be sniffed at, against £5.6 billion in 2021. The final topic for attention, barring an update on Mr. Venkatakrishna's well-being, will be the dividend. Barclays paid an interim dividend of 2.25 pence, up from 2p the year before, and analysts are expecting a final payment of 4.8p to take the final full-year total to 7.05 pence a share. That's worth around £1.1 billion. On top of that, the bank continues to run a share buyback scheme. Barclays ran two programmes worth £1.5 billion in 2022, and analysts have penciled in £675 million for the next tranche to set the bank on its way to around £1.2 billion of buybacks for the whole of 2023. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.